No. All right, good afternoon, everybody. I want to first off say thank you for joining today. My name is Phil Bresch, and I am here to talk about how to illustrate in a multi-carrier environment. So one of the most beautiful things about being in this independent world is there's plenty of carriers at your fingertips. Here at Valor Financial Specialists, we have at least 40 carriers at our fingertips to help support you and your mission and your goal to provide value to your clientele. And so what I like to say is it's your vision, our expertise. There's definitely a lot of different scenarios or solutions out there through these different types of services that we offer, like income protection, estate planning, so on and so forth. So what we're here to do is really just help you, add value to your clientele. And that is my direct cell phone number, email address. Feel free to text, call, email me, whatever. I'm here to support you. So, just want to start off with a slide that I used in one of my prior presentations, but it is very alarming. In what we do is really and truly a noble profession, given what we're here to do is provide protection and resources available when someone can't make it home tonight for whatever reason. And so we see some scary statistics in 2021, January, 52% of consumers reported owning life insurance. So that's not just, what we sell in the individual side, that includes employer owned. So group insurance too, down from 63%. And mind you, that's after the big surge we saw with COVID, when a lot of people wanted life insurance because they were fearful of their own mortality. Now we're seeing that half of the consumers out there today have life insurance. And given the fact that we have over 330 million people in the United States, that tells me that we need to do a better job of talking about this. We shouldn't be afraid to have a no, because there's plenty of people that will find value in this. 42% of American households say they face financial hardship within 6 months of a wage earner passing unexpectedly. And obviously, COVID increased those heightened awarenesses to the things of life insurance. So we really should kind of move on from that and understand that we have a big part to play in this quote unquote new world. So really what we're going to talk about today in our agenda, we talk about term insurance, because yes, term insurance still is important. We have a way to illustrate basic needs protection, but also a value needs protection, the new kind of insurance or the new kind of term insurance in this scenario. Then we'll spend a lot of time on permanent insurance, mostly the accumulation sales, really what to look for as an agent on how to illustrate appropriately. And then once we do that, we can take the next step and talk about things like leverage permanent insurance sales. And then ultimately, what type of action steps are you going to take after, we have this presentation today? So let's dive first in to talk about term insurance. And really, when we think about the term needs, it usually falls in the trifecta. This is not my family or my house and not my paycheck either. That'd be nice. But in this scenario, when we think about term insurance, we talk about the major things of why people need it. So mortgage, you want to protect your total outstanding debt, your paycheck, and ultimately those kids, you want to make sure that they have the ability to make it to college, get through college, and ultimately talk about why they should get insurance early as well. And so when we talk about a simple evaluation, there's plenty of people who talk about different scenarios or different ways to do it. I'm more of a keep it simple kind of guy. So when we think about the three main reasons, paycheck, your outstanding debts on your mortgage, and your kids, you can do a simple evaluation, say 10 to 20 times your income. Someone makes $100,000, you're already right at $1 million. Pretty easy math. Then you add in the outstanding debt, how much is left on the house. They bought a $500,000 house, $250,000 is left. There's another $250,000 in coverage. and then they have one kid, so there's another 250. They say the average cost to raise a kid to the age of 18 is about $218,000, I believe, was the last time I saw it. So giving you rough ballpark figures that you can do off the top of your head without pulling out a huge financial needs analysis. Don't get me wrong, you can do that too. But if you want to talk about something quick and it makes you sound very efficient in the way you're speaking to the clientele, that's an easy way to do it. And we have those type of solutions here. If you talk about someone who's really looking for the quick and dirty, as I like to say, we have that. We have all the termite companies, like Protective, Banner, AIG, usually the top three when you see any type of term type sale. And so all of these companies are always fighting over pennies. So if you have a client who's like, I want to see a spreadsheet of carriers, and in the past you're like, well, I only have 3 or 4 carriers that I work with, take it or leave it. Now you don't have to say that. You don't have to lose out on the opportunity. And I'll show you how to illustrate those. But then we think about some of the other major concerns. That's the old type of insurance. If you have to die, then a payout gets paid to the beneficiary. But when we think about other concerns like major health events like heart attack, stroke, cancer, that happens so often we don't think about it. And a lot of times our customers don't even know they need it until it's too late. So that's why we're here to help them plan in advance so they don't have to worry about that concern. That's why we talk about life insurance that you don't have to die to use. So if, for example's sake, your client has a heart attack, stroke, cancer, you can actually accelerate the death benefit so they can get a cash payout. You can do the same with chronic illness. So if you can't perform 2 out of 6 activities of daily living, you can actually access the death benefit to give you a cash payout once again, or acceleration. And terminal illness, I'm not going to lie, every carrier has terminal illness, but in these scenarios, some carriers do 24 months, some do 12 months. We have a whole slew of carriers at our fingertips that do offer living benefits. And so when you look at the first example of the, like I said, quick and dirty, that's your dirt sheet term carriers fighting over pennies. This is more of a value sale. You can always use the analogy of the cell phone. Does someone buy a flip phone still and they text with T9? You don't really see that. What you see is more or less people buying these smartphones. And why is that? Because it has more value to it. So that's where this living benefit story comes in. Now, on the permanent side, what we think about here is, why would people buy permanent insurance? The basic reasons why you see here, it's no longer temporary. The old joke is that if you could tell me when you plan on dying, I'll give you the right type of insurance. But obviously we know that no one knows that. So you don't want to have something that's temporary if you can afford the permanent. I think that's the better opportunity, because it'll be there when you need it most. Talk about cash accumulation. A lot of people use the cash accumulation for retirement strategies. You can use life insurance for retirement strategies. We talk about legacy planning. So you have a grandma and a grandpa who want to leave some money to their grandkids. Because let's be honest, grandparents don't like their kids anymore. They like their grandkids. So why not leave a legacy to their grandkids? And then estate planning. If you have people who make a lot of money and they want to hide enough of it from taxes per se, or protect their overall estate is a better way of putting it, that's when you start talking about estate planning. But today we're going to focus on accumulation, how to grow accumulation inside a life insurance-based product. We're going to focus on the IULs today. And why is it so important? When we think about some of the assets that we can accumulate over time, there's really 3 buckets you can put it into. CDs, money markets, mutual funds, savings accounts. That's your tax now vehicles. And they can be a good money generator like mutual funds. But unless you're looking at the stock market every single day, how do you know which mutual funds are good to pick? You have to research. A lot of people will usually pick a financial advisor up for that. So not only are you getting taxed now, but you're getting charged to have a financial advisor do the work for you. So a lot of people shift their money to the tax later vehicles, which when you go to tax later vehicles, you're going to see that we're at an economic low for tax brackets. Like the top marginal tax bracket is about 39%. And when you think about that, say in the 50s and the 60s time frame, around there, you're looking at 70, 80, 90% as the top marginal tax bracket. So if we're putting all our money into a tax deductible contribution bucket so we can get tax breaks today, for tax deferred growth so we can take it out later when we think our tax bracket will be lower, well, let's all assume we know that taxes are more than likely on the rise up given our current environment. We're actually reversing the idea of the benefit that we could receive in retirement. So when we talk about tax never assets, you've received the money, you've invested it now, and it will never be taxed again. That's where you talk about Roths and you talk about cash value life insurance. Roth IRAs are fantastic, but there's a limitation to them. So this year in 2023, 6,500 is the max you can put in if you're 50 or below 50, I should say. But when we think about it, it becomes a dead asset when you make too much. You have limitations as a single breadwinner or jointly married. And so that's where cash value life insurance comes in. It's kind of like a Roth on steroids, because as an income earner, you can put in more than 6,500 into a cash value life insurance policy that's focused not on a high death benefit, but on a low death benefit. So you can stuff more cash in and push it more towards investment versus cost of insurance. And so we like to think of those as self-completing plans. If I don't make it home tonight and I did one of these type of plans, then my wife still has a death benefit that she can use for her retirement, rather than me putting it into a Roth and getting plus or minus whatever the gain is. So that's where some of the benefits of life insurance come in. It doesn't matter what your income is. And if you can afford it, you can put in as much as you want. I've done plans like this where people have invested $100,000 a year for 10 years. And it got approved by the insurance company because they could fiscally afford it. So when we think about these type of solutions and strategies, there's certain questions you have to ask your clients. So these type of quotes that you want to get, whether you're running them or I'm running them, because I'll gladly do that for you as well, you have to understand the mechanics behind how to get the illustrations. First off, the name. You always want to personalize it with a name. Never looks good when you talk about Mr. Client or Mrs. Client, but if you personalize it with your name, that's the first perfect touch that you can always add to any illustration. Date of birth. Some carriers are age nearest. So my birthday is in December. So 6 months before December and 6 months after is my insurance age with some carriers. Other ones are age last. So you'll get your current age will be what the insurance company would illustrate at. Health. That's always a fun question. We're in the industry to talk about health. How good do you feel? Because the insurance company is going to analyze all of that. So a nice way of asking the question, Mr. and Mrs. Client, if you could rate yourself on a scale of 1 to 10, 1 being 1 foot in the grave, 10 being the body of an Olympian, you're ready to go run a marathon, where do you feel your health lies? And let them answer. So I say a 6. So why are you a 6? Well, I'm a little overweight. I have to take medication for blood pressure, things like that. You can help them open up the conversation without saying, what's your blood pressure? What medications are you taking? Blah, blah, blah. So it engages in the conversation easier. When you talk about how much are you willing to, when we say that, we're saying, what are you willing to invest in this type of strategy, this accumulation strategy, on a monthly or annual basis? Some people can do quarterly, some can do semi-annual, but mostly you see it's either monthly or annually. Knowing your customer or consumer, if you talk millennials, younger generations, 20s, 30s, they can only break it down by monthly. When you talk about a little bit older generations, they can do annual, no problem. Or if you're talking to people who are just fiscally, savvy, then annual is the best way to go. And then you talk about duration of funding. Mr. and Mrs. Client, if you can not afford, but if you can think of a number that you can utilize in this type of investment strategy for the next 10 years, what would be that number? Or 15 years, depending on the age, or 20 years. Give them a scale or a time frame in which they can invest it, but then also have time to let it grow and accumulate without them putting extra money in, unless they want to. But then you talk about income. What type of income are you looking for, or more or less, when do you want to take out income? Some people want to retire at 50. Some want to retire at the traditional 65. 67 is the new 65. Some people want to go to 70. And so you can think about when you want to take that income out and ultimately for how long. Most people, I usually run income till about 85, because if you think about a male's average mortality, it's usually till about 82, 79 to 82. So I'm expanding that a little bit. But, I've seen people illustrate income all the way to 121. That makes no sense, because I don't think anybody here today will live to 121. And if you do, God bless you. So that's why I say make it realistic, make it simple. And these are the type of questions you want to look for. So what we'll do is we'll run an illustration on a case study. I'll use my good old friend Ray Lewis, 40-year-old male, preferred non-tobacco, motivational speaker, making about 400K a year. And he's going to take income out at 65 for about 20 years. I'll actually stretch it to 90 for him, so 25 years. And we're going to target income of about 40,000, because they say you should invest 10% of your income every year in order to have a fighting chance of retirement. So he invests 40,000, 20,000 is going to go into his current 401k, and then we got 20,000 to play with. So we're going to take a look at that strategy as well. I will show you the illustrations of the term, illustrations for this, and then ultimately, if we graduate or move up and we understand the other sales, this is right around the corner too when we talk about leveraged permanent insurance sales. What I mean by this is, if we think about some of the opportunities and strategies we can offer our clients, we think about, let's say you have $100,000 and you want to buy a house. If you buy a house at $100,000 and it's a $100,000 house, then you bought it outright. Congratulations, you own your home. But it's probably not like a really big home, right? It's probably more of a basic home, which is good for some people. But if we utilize the bank, if we leverage the bank and maybe bought an $800,000 house using the $100,000 as leverage, we can get a better valuation in that type of solution. So same thing with cars. You could buy with $10,000, you could buy a basic car, probably a used car, or you could use it as a down payment, leverage a bank to help you get a better, nicer car. So the question is always begging, why can't we do that for retirement? Well, we can through strategies like what we call bank-funded retirement strategies, or Kaizen, where you offer the opportunity to the client where the client pays half the premium in the first 5 years. The bank actually pays the other half. And then in years 6 through 10, the bank pays the whole thing. So strategy looks like this. We're going to use little piggies as the analogies for funding. And we're going to take a 40-year-old male, you see the top left-hand corner of the screen, and average health, and they're going to contribute about $40,000 a year. So you see the minimum's $21,350. Doesn't mean that you have to always do the minimum. This is a question, again, that you ask the client, what do you think you're willing to invest in these type of strategies? And then they give you the number. And so in this scenario, 40-year-old has contributed a total of $200,000 over a 5-year period. The bank has contributed over $500,000 over that 10-year period. And then in turn, what happens is you'll find that you get a $1.3 million death benefit to start, 65 to 90, the client is getting about $112,000 in income. This is illustrated off of 5.64% rate of return. And they've accumulated or taken out a total tax-free distributions of about $2.9 million. Once again, that's off a $200,000 investment over a 5-year period. To qualify for this, you need to be a high income earner, at least making 100,000 or more in W-2 income or K-1, type income for the last 2 years. But these opportunities are out there as well, and we can definitely help you out with that here at Valor Financial Specialists. So what I'm going to do now is I'm going to bring up the different ways in which we can illustrate things. First things first, we'll talk about the idea of quoting that term, the basic needs term, because that's simple and easy type of opportunities. Someone's like, hey, I've got a bank collateral I need protection for, or hey, I just need death benefit protection. They don't like the idea of living benefits. Well, we have our carrier or our partners here at 3Mark Financial, who Valor Financial Specialists uses for our quoting engine here. You'll see a 40-year-old male, Tennessee resident, $1 million death benefit. All of this is changeable. You can add date of birth, change male to female, whatever state you're in. Face amounts, I can do several amounts. So if I want to do 500,000, 750, 1 million, and maybe 2 million, I can do all of those all at one time. Pay it monthly. And let's say, well, I know I'm not super preferred. Let's just go with preferred. And then I'm going to do it for 20 years. And you'll see all of the carriers just got piled into the quote engine here. Click default report. And slowly but surely, what we'll find is we'll get a full report on what type of opportunities are available from just a simple term sale. Now, once again, it does take a little bit to generate several quotes. And while we're doing that, I'm going to start pulling up the way to run the multi-carrier illustrations. And what we see here is, now you're fighting over pennies at the top, 3511 from John Hancock. I usually am not a fan of the vitality term. That's a different conversation for a different day. But I'll show you how you can remove carriers you don't really want to show to. Protective, banner, AIG selected term are usually the top termites. They're always usually at the top when it comes to cost-efficient term. And this is for 500K. Then we go to 750, keep scrolling, 1 mil, 2 mil. So you'll notice here that you don't have to worry about losing a client. You have all the carriers at your fingertips to allow you that ability to be that multi-carrier specialist. Now, if I go back, like I said, I'm not a big fan of the Hancock vitality term. They use a thing where you have to use like a Fitbit to measure your health. And so I don't really feel like doing that 20 years down the road. So if I were to want to get rid of John Hancock, all I would do is double click, remove, double click, remove, double click, remove. And now voila, they're no longer on the spreadsheet. And then all I have to do is go back to my view and hit default report, and you're on your merry way. And Hancock will no longer be number one. It will no longer be actually even in the illustration generator. So if you had a bad experience with a carrier, you don't feel like using a specific carrier, is some reasons why people do this. But once again, as I mentioned, Hancock's gone, banner, protective, like I said, the major termites are at the top. So that's what you see from a term engine. Very simple and easy, but as I mentioned, this is not the value sale, this is the basic dirt sheet needs sale. So if I were to show you the opportunity, and I'm going to use, tried and true, my old hometown carrier, if you will, the AIG QOL term, now Corebridge. So AIG was spun off their life and retirement to a separate entity being Corebridge. And if I just did Mr. Client, male 12, I'll just say 40 because I use in the other example, preferred non-tobacco, Tennessee, your basic information here, solve for, and I'm just going to do 500K, which was the first one we saw in a 20-year term. AIG is the only carrier to have several different options, not just 10, 15, 20, and 30. They have several options, but we're going to do monthly and nothing else. I'll hit calculate here. They're not going to show up in this spreadsheet. You have AIG select a term. This is AIG QOL flex term. It's a different product because it has living benefits in it. So if you want to see a value sale, you have AIG, you've got North American. I showed you the list of all the living benefit carriers that we have. So there are several of them. But you'll see here, it's $39.95. If you see here, it's $35.45. So can someone spare one less Happy Meal a month to give you chronic, critical, and terminal illness protection? It's a better story. That's why usually if I run this spreadsheet, I actually take off the selected term too, not because I don't like it, but because I think I have a better version of the AIG product with this QOL portfolio. So term is pretty simple. It's pretty easy. You can run all the carriers the same way in term on this. So in case you want a PDF using WinFlex, which you have access to through us, if you don't know how to get there, we can do a separate side training on how to get you into WinFlex. So that's not a problem at all. So let's talk about accumulation sales, the value proposition and how to run accumulation sales, not just one carrier, but several carriers at one time. So if I hit start a new case, I'll start out with my, Corebridge anyway, and we'll go here and we'll start filling in the details. So again, I used Ray Lewis, male, 40, preferred, Maryland resident. For those who don't know, I'm a Ravens fan, so this is a tribute to one of my favorite players. But anyway, so in this scenario, as we're looking for income, we don't care so much about the death benefit. We care more about what they're putting into the policy every single year. So in this scenario, we're going to solve for the face amount because we know the premium. You either know the face amount and you're solving for premium, or you're solving for face amount because you know the premium. You can't solve for something if you don't know either. Okay, so just kind of forewarning on that. So we're going to solve for face amount, and I'm going to take this option and change it to minimum face, no match. And in the scenario I talked about, he was going to invest $20,000, and he's going to do that for a total of 15 years. So if you saw what I did it really quick, and I apologize, but there was a little calendar. I opened up the calendar so I could actually dictate how many years I want to fund it for. Change from 1 to not match, but 1 to 15. You can do it by age if you wanted to, but 16 to max, I'm going to double click here and put 0. So it's just 15 years of funding. We can talk a whole different strategy or a solution about all these index strategies. I'm going to keep it plain vanilla for today. Okay. Disbursements, I'm going to check this box here because we're going to show income, and we want to show income. I'm going to click the calendar once again. And this time I want to show age. I'm going to click on age. So 40 to 64. I don't want to take any income. I'm still funding. And then at 65, the average retirement age, we're going to put 65 to 89 because the illustration will actually show it 66 to 90. It's still 25 years, but it's just, the way the illustrations are designed. And I'm going to drop down here and click solve for max. That's it. Okay. Nothing else is going to change here. Once again, keeping it plain vanilla. Now, last but not least, when you are funding for a least amount of face amount, you want to change. It might come up as level initially. You want to make sure it's increasing. But when you're done funding, you want to make sure you stop increasing and you want to change that to level. Why? increasing has higher costs of insurance. But when you start out at increasing, you're basically finding the max amount of premium you can put in the least amount of death benefit. And so once you stop doing that, you still have those charges. You want to mitigate those charges and reduce it down to level, which again, if I go back to solve for, I was funding for 15 years. In year 16, I changed it to level, and that's it. So this is one carrier. I know I did it correct. If you feel as you're doing this, you want to run the illustration first to make sure everything looks good, fantastic. But as I mentioned, the whole premise of this is how to run multi-carrier. So I'm going to click on this little copy button right here, and now I got two Ray Lewis's. But I don't want to run two of the same illustration, so I'm going to change the product. And let's just say we go to Allianz. Allianz is a big carrier in the accumulation IUL space, very utilized quite often. And let's say I just change the product. Now you'll see here that there are some things that I have to fix, some errors, because every property from every carrier is a little different. So you always have to go through and make sure what you did stays tried and true, so to speak. So I'm going to say fix all errors here. And I'm going to just review. So 40 preferred, Maryland, solve for, minimum face, max accumulation. I'm going to change that to year to confirm, 1 to 15, 20,000. Disbursements, 65 to 89. Everything is the same. Policy options, we're going to do increasing. You see why I click on it though? Because there's little changes that happen. And then premium mode annual. If you want to do monthly, it's right there, you know, with the carriers. So I usually like to show 4 carriers just to show I'm not biased to one carrier, but we can always talk about maybe initially showing 4 and then working our way down to 2. I'll add in now another carrier. Let's say, for example's sake, I'll go through, I like Symetra. Their Ascent, Accumulator, Ascent, IUL. You'll also notice when you go through these illustrations, you'll see some say accumulator, some will say protector. So you always want to go, if you're doing accumulation, to the accumulator product. So we'll click update client here. And once again, they're asking additional questions. I'm going to fix the errors. Everything's good there. Not changing the indexes. Solve for minimum face, 20,000. Disbursements at the right age. Policy options increasing. Once again, I just click on it and the things change a little bit. And then last but not least, I'll add one more carrier just for funsies. I'll bring up, let's just say, I don't know, F&G with their path setter. Click update client here. And they're saying, hey, I got to change a few things. So I'll just say fix errors for now. And I'll go through and make sure everything is accurate. So minimum face, no mech, face solve, 20,000, age, everything is the same there. Then we do interest credits, that's all accurate. Disbursements, just checking the age again, solve for max, you see how that changed. Target age 100, blah, 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 so we're good there. Increasing, it changed once I clicked on it there. And we should be good to go with these carriers. So normally what people would do is they click on each individual one, or they'll click this orange calculate. If you hit select all and calculate, it'll run them all at the same time. So I see a couple good questions in the Q&A. I promise I'll answer those, you know, once we kind of go through all this. So I know I got, you know, a few more things to go through, and then we'll kind of dive back into the questions. So here you have all 4 carriers. I did not get any errors that popped up. So I know I did it right, at least on this standpoint. You'll see premium payments, 15 years, 15. Sometimes they don't like showing it. It could also mean that I messed up, but we'll check that. and then 15 there. You'll see every carrier has a funky death benefit. It's all different depending on the carrier. Now, why is that? Every carrier has different actuarial tables. They all look different. And so if I clicked on AIG or Corebridge, I got to get used to saying that. But if I click on this illustration, it'll slowly pop up. And what we'll find here is it'll be the full illustration. So if we go through, we want to skim and make sure everything is accurate. So I'm just going to go to the tabular detail page, or I call it the money page. And you'll see here, 20,000, 15 years. So a total investment of 300,000. And then we start taking out income. Like I said, 65 to 84, start showing there at 66. So 76 grand all the way out to age 90. So that did its job. Okay. Then if I'll check the next one, let's go with Allianz, and you just kind of rinse and repeat as you go through these. Now, the most important thing about doing this, and I'm just going to overstress this, is the illustrations are designed to entice your clientele to purchase the product, as we all know. Everyone runs different illustration rates. So AIG ran 6.48. This is running at 7.04. Okay. So what I like to do, I like to temper the expectation of the client and run everybody at 6%. Personal opinion, you don't have to do that. Whatever you want to do to get the sale, but I like to temper the expectation, under promise and over deliver. But you'll see here, same investment, 300,000. And then we go down to 66. You get 101,796 a year, all the way to age 90. So about 2.5 on a $300,000 investment. F&G, I'm just curious because it didn't say 15 years. So I want to see if it did it right. And it did. And they're at 115,000. So what you'll notice here, they have a 6.91% rate of return. So different than Allianz, showing higher income, but there's trade-offs. You know, if you've been doing this a while, you can know what the trade-offs are. I can definitely tell you those offline as well. But all these carriers have different niches and different value propositions. So if you want to send all of these to your client, you can simply just hit send. And I could just say here, sample case, and then hit save. And then what will happen is it'll save it in your WinFlex account. And then what will happen is you'll get a generated email that pops up. So it says, hey, your illustrations are set. Now, what I like to do is I like to send these to myself. I'll send them to myself. And then what I'll do is I'll do a little write-up with all the carriers. I'll say, hey, this is the carrier, this is the rate of return, this is the amount of income they got, and list them out. And then if they want to, they'll have an email that will say, click here to see the quotes, and it'll send them all 4 of these quotes in the PDFs. So you don't have to attach all these illustrations. You don't have to save them all to your desktop. They're all saved inside of the WinFlex web. And so this is a great tool to help you find the right products for the right type of clientele. And having someone like me to help you figure out the best way to position these, because I've sold all these carriers in the past. I know the pros and cons of all of them. And so there are pros and cons for all of them. So it just depends on your client. Underwriting comes into a mix as well. You may not have the most healthy client, and so maybe F&G won't even work for them, or Allianz or AIG. So just kind of remember that too. Now, the last thing I'll show you is if you can elevate the game, if you will, to a premium finance type of conversation. That's that bank funded strategies. We have this interactive software that you can utilize. And for example's sake, if I were to show you kind of what I was showing you before in the strategy here, we're going to pull up a demo and I can show you, estimate my benefits. Once again, this is where I did the 40-year-old average male, and I did $40,000, and I hit calculate, and it'll pull up all that information. So here comes the pigs again. Here's what I've invested. Here's what the bank invests, benefits and distributions. So everything I showed you before, this is where it can happen. And once you get into this world, you get the software after you sell your first Kaizen case, and then you can send these out to your clientele. You get little links that you can post on Facebook, so you can market that way too. And then what happens is if the client likes it, they're going to click on get started and enroll, and they'll start their side of the application. Very easy to do, very intuitive. Some things that I really like about this strategy is a lot of people say, oh, well, the interest rates are so high right now. Why would I invest in that? Well, Kaizen has actually leveraged these strategies and the carriers to make sure that these are appropriate to use even in some of the toughest conditions. Like in the 1980s, when the interest rates went up to about 15%. So they run this, instead of 49,000 in this example, you'd get 37,000, but you'd still get retirement income. If you talk Great Depression, they actually battle tested this with 9 zeros out of 15 years of funding and how the policy's set up. And you still walked away with this last number here that'll show up in just a second, 32,000. So even though people think that the interest rates are higher today, you can still get a strong leverage conversation with these type of strategies for your clientele. And so to kind of round this out, I'll round this out and then we'll answer some of the questions. I want to share some success stories that we've had here at Valor Financial Specialists. For example's sake, we had 2 clients, or 4 clients really, who they were with an agent who in a prior IMO couldn't get it through. There were a lack of financials for the 68-year-olds to get $3 million and $6 million for the 40-year-old husband and wife. We got them all approved with a different carrier who viewed financials differently, and the agent walked away with a $356,000 commission. We have other carriers that work well with diabetics. So, I live here in the South where people have a touch of the sugar. And so when you talk about this 56-year-old male, 8.0 A1C, sleep apnea, also had a cardiac concern, we were able to secure a $3 million policy at Standard Non-Tobacco. And a 50-year-old who had a 7.1 A1C, and his father passed away before age 60 of a heart attack at age 48. And we were able to secure $10 million at 40 at a preferred non-tobacco. So the opportunities are out there. That's the beauty of this multi-carrier environment, is if one carrier doesn't give you the offer you're looking for, we can pull it back and shop it to the other ones informally. So no new application, but informally to see if someone can offer a better solution. And so I ask you today, what's your plan? If you believe in these type of solutions and you're passionate about what you do, wouldn't you want to talk to everyone about this kind of stuff? 330 million people. So someone's got to say yes. So think of at least 3 clients that you want to talk to and write them down, whether it's basic term or accumulation opportunities or that leverage bank financing strategy. And give me a call. You can text, email, call, whatever, and I'll gladly help you out. And if you are just starting out with us and you're looking for more opportunity to grow, we have what I call a pathway to management. So if you have other agents that you feel could benefit from this opportunity as well, you can bring them into the fold, have an opportunity to accumulate and grow together. The more you sell, the more you make. And there's pathways that lead even beyond just this 90%. So you can grow here. You can get carrier bonuses, like AIG still has their carrier bonus of 20% above $30,000, in a cumulative year. You get 20% bonus on everything above 30,000. You also have carrier trips. So Corebridge has their carrier trip they announced. It's Amelia Island in Florida. Columbus, I know last year or this coming year, I have a flyer down here. It's the Bahamas. So National Life Group, we're trying to get on theirs as well. So depending on which carrier you like to go with, these are the ones that I like to start with. We have more carriers I already showed you, yes. But if we're talking about a pathway to bring people in and grow, these are the ones I usually like to start with to, keep it as easy as possible. Doesn't mean the other ones aren't there. And lastly, like I mentioned already, there's additional compensation opportunities based on production. So the more you sell, the more you're going to make, promise. And you have the ability to build teams in the structure too. Follow us on YouTube, Facebook, Twitter, Instagram, LinkedIn, and soon to come TikTok. I got the setups for everything. All these trainings are going to be on the YouTube channel. So future opportunities to rewatch and utilize. And really, that's it. So I want to say thank you guys for attending. I have a few questions in the Q&A here that I'll answer. But for those who good, I want to say thank you so much for the time and more trainings to come. So